Hey everyone! Welcome back to the channel. In today's video, we're diving into a topic that could significantly impact Canadian investors: what Trump's tariffs would mean for Canadian investors. To start, let's quickly break down what tariffs are. Essentially, tariffs are taxes on imports, taxes that Donald Trump might impose on goods coming from countries like China, Canada, or the EU. When tariffs rise, prices go up, supply chains get disrupted, and market uncertainty increases. But how does this play out for Canadian investors? Now, let's look at ETFs like VFV and XEQT. VFV tracks the S&P 500, which is made up of 500 major American companies. Many of these companies, like Apple, Tesla, and Microsoft, rely heavily on international trade and global supply chains. So, when Donald Trump imposes tariffs, it increases the cost of doing business for these companies. That means their profit margins might shrink, and stock prices could drop. Take Apple, for example. A lot of its products are made in China, and any tariffs on Chinese goods could lead to increased costs for Apple's components. This could then impact their stock price, affecting anyone holding VFV. Now, XEQT is a little different. It's a global ETF, meaning it holds both American and Canadian stocks. While America may feel the immediate impact of tariffs, Canadian companies in XEQT that rely on exports could also face challenges. For instance, if Canada's major trading partners face tariff hikes, Canadian exporters might see reduced demand, which could affect their stock performance as well. That's not all. While American stocks might struggle due to increased tariffs, the American dollar could actually benefit in this scenario. Here's why: when global trade tensions rise, investors often flock to safe haven assets like the American dollar, which tends to appreciate during periods of uncertainty. A stronger American dollar could make American products and assets more attractive, driving up demand for American-based companies, particularly in VFV. Meanwhile, on the flip side, the Canadian dollar could weaken. As America's tariffs hit global markets, the strength of the Canadian dollar might decrease in comparison to the American dollar. This is especially true if America's exports slow down and trade between Canada and America is affected. As the Canadian dollar weakens, Canadian stocks that rely heavily on imports or international trade could also take a hit. Companies in XEQT that deal with raw materials or exports might face pressure as the cost of doing business increases or demand drops. In a worst-case scenario, the weakness of the Canadian dollar could even lead to inflationary pressures, pushing up costs for consumers and businesses alike. So, how can Canadian investors navigate this potential volatility? Diversification is key. A well-balanced portfolio that includes exposure to both American and Canadian stocks, bonds, and other asset classes can help mitigate the risks posed by tariff hikes and exchange rate fluctuations. For example, consider diversifying into sectors that are less sensitive to trade tensions like healthcare, utilities, or tech. These sectors might not be as exposed to the effects of tariffs. And by holding both American and Canadian assets, you can benefit from the strengths of each economy, regardless of what's happening with tariffs. One tool I recommend for diversifying your portfolio is WealthSimple. It makes it easy to invest in ETFs like VFV, XEQT, and others, so you can get exposure to both Canadian and American markets. WealthSimple offers simple, low-cost investing and allows you to manage your portfolio with just a few taps on your phone. And for those new to WealthSimple, if you sign up using my code INSERTYOURCODE, you'll get $25 to start your investment journey. It's a great way to get started, even if you're just beginning to dip your toes into investing. Let's not forget that tariffs and trade wars can lead to significant volatility in the markets. However, this volatility is often short-term. Markets have a history of bouncing back, and the long-term trend tends to show steady growth. For long-term investors, the key is to stay calm during the storm and focus on the fundamentals of the companies you invest in. While tariffs might cause some short-term pain, they also create opportunities. For example, if stock prices dip because of tariffs, it could be a chance for you to buy quality companies at a discount. Long-term investors know that timing the market is impossible, but staying invested and diversified over the years usually leads to better outcomes. At the end of the day, staying informed about global events like tariffs and trade policies is critical. But don't let short-term volatility derail your long-term investment goals. Diversify your portfolio, stay patient, and make smart choices to minimize risk and take advantage of opportunities. If you found this video helpful, don't forget to like, subscribe, and comment below if you want to dive deeper into how global issues like tariffs affect investing. Use my WealthSimple code to get $25 and start investing today. Thanks for watching, and happy investing!